IPO and tech enthusiasts are excited about the Arm Holdings plc initial public offering, and with good reason. It's the first big tech IPO in more than 2 years. A lot is riding on its success. In this case, success for investors means demand is high and the price rises in the weeks and months after the IPO. Still, initially the deal will mostly be lacking one natural buyer: exchange-traded funds. Arm will be launching its IPO Thursday on the Nasdaq, selling 95.5 million shares at $51, the high end of the expected price range of $47.51. Tech investors increasingly use ETFs to gain exposure to broad tech sectors and subsectors like semiconductors. However, some investors who would like to get immediate exposure to the Arm IPO through ETFs may be disappointed. ETF indexes have inclusion rules. ETFs are generally a desirable target for corporations to sell stock to because the ownership base skews toward passive and long-term ownership. However, this particular IPO highlights several difficulties that even large companies like Arm have in acquiring a broader ownership base through ETFs. For the most part, ETFs are structured to track indexes. These indexes have rules that must be carefully adhered to in order to qualify for inclusion. Unfortunately, partly due to Arm's own decisions and partly due to the way the major indexes are constructed, Arm initially appears to be ineligible for the largest ETFs. Problem number 1. Arm is not in the S&P 500. The largest index provider is S&P Global, to be included in broad technology ETFs like the SPDR Technology ETF ZLG, which tracks the S&P 500 Technology Index. A stock must first be in the S&P 500, which Arm is not. The first problem is that Arm is not a US company. It's British, which generally would exclude it from the S&P indexes. Next problem: a free float below 10%. Many tech companies now routinely float very small amounts of stock, 10-15 of the shares outstanding, because restricting supply increases the chance for higher prices. But Arm appears to be particularly parsimonious, floating roughly 9.3% of the company, according to Renaissance Capital. That is another problem for many ETFs, which generally require that a company float 10% or more of the shares to be eligible for inclusion.